Now let's take a look at the bigger picture. Anthony Saccaro is with us, president of Providence Financial and Insurance Services. Well, we saw some recent all-time highs. Are we more cautiously optimistic or cautiously pessimistic now?
Yeah, I mean, that's the question, right? We're getting a lot of mixed signals as to what's going on. The Federal Reserve, on one hand, has said that they're not going to raise interest rates this year, which there was some concern as to the fact that they might do that. But they've also said, or they've become a little more hawkish in their stance for lowering interest rates as well. The fact is that the inflation data and the consumer data is softening a little bit, but it's still higher than the 2% that the Federal Reserve wants to see. So it's become recent conversation that the Federal Reserve might not even lower interest rates at all this year. We would end the year with an expectation of 6 to 7 rate cuts. Now I think it's forecast that there might only be 2 rate cuts. And I've been saying for several months now that I wouldn't be surprised if there were no rate cuts at all. And then especially in light of the fact that we have the presidential election and you'll throw that into the mix. So there is a mixed bag. You do have to be really careful at this point, especially if you're on the brink of retirement. That's where I think the concern is. If we have a major crash right before you want to retire, then you could have some problems ahead.
Yeah, I mean, when you say 2 cuts is what you thought, it could be 0. What do you recommend the Fed do? What would you do if you were, head of the Federal Open Market Committee?
Yeah, I mean, great question. I would recommend they stay the course. I think they're actually handling it very well. I think they're handling it right. I think Jerome Powell's Fed speak is great. I think they're doing a good job. I wouldn't change anything at this point. I wouldn't lower at this point. They have to have a reason to lower. And the question is, are they going to lower proactively because the economy has done so well and inflation's come down to where they want it to be? And so now they're, adjusting the economy and they're being proactive? Or are we going to get some bad data at some point down the road that's going to cause the economy to get into some kind of a correction or tailspin? And now they're going to be forced to lower interest rates reactively. So they want to be proactive, not reactive. Inflation's a lagging indicator. It is starting to soften. Consumer savings are going down. Consumer spending is going down. GDP is only forecast to be, I think, if I remember correctly, I think 1.6% this year. So that's going down. So everything is going in the direction that they want. Stay the course. Just don't change anything.
I see. I see. So in the meantime, you said if someone's, planning their retirement and the market goes down right when they're ready to retire, I mean, really, you need to plan for that, right? I mean, you're hedging to both sides, aren't you?
Well, that's exactly right. And, what you'll hear from Wall Street is that the market goes up all the time, right? And that's true over, any 20 or 30-year period of time. But there's been lots of decades or decade and a half periods where the market has just swung sideways, crashes and recoveries that are just washing each other out, resulting in a decade or decade and a half of zero return. And we've had a decade and a half now of 15% plus return in the market. And there's a lot of people that are concerned that the next decade may not look anything like the last decade. And we know the market's not going to go up forever. Nothing goes up forever. And if we have a major correction or major pullback, or even worse, maybe a crash like we had in '01 or '08, and if that happens right before you're going to retire, it may cost you the ability to retire on schedule. So what I recommend is put yourself in a position to be able to retire no matter what. If that means shoring up your portfolio and focusing on more income producing, more conservative investments, then I think that's what you need to do.
Right. I want to circle back to your thoughts on the PCE because there's a few of them coming up, and it's something that are watching very closely because the Fed's watching it. How sticky is inflation, and are you using the PCE print very closely? Is that your favorite one as well?
Well, yeah, the PCI and the PCE work together. They're very similar. They just measure the basket of goods differently. And that's why the PCE and PCI usually correlate with each other. PCE is usually a little bit lower. I want to say that the last PCI print was 3.4 and the PCE was, I think, 2.7. If I'm correct, don't quote me 100%. But the fact is that's what the Federal Reserve likes to use. And it's a more realistic example because it actually measures the consumption of consumers, not just a basket of goods that is randomly chosen like the PCI uses. So it is one of the ones that we watch when it comes to inflation. It's certainly what the Federal Reserve watches. Their target rate is 2%. The PCE is still above that, but it's approaching that range. And so I think that it could give them reason to maybe want to lower once or twice this year, but it is something to be in touch with. And as Jerome Powell says, it's all going to be data dependent, right?
When you talk about capital preservation, you mentioned the dividend payers, maybe certain bonds. Which bonds and or dividend payers, how do people sort of pick what to go with?
Well, interestingly enough, almost any investment that is growth oriented can also be engineered or set up for dividends. And that's one thing I think a lot of people don't realize. You can buy bonds that are growth oriented with no dividends at all, or you can buy bonds that pay dividends. You can buy zero coupon bonds, I'm sorry, stock that pay no dividends, or stock that pay dividends. Bonds, same thing. You can buy zero coupon bonds, which are purely a growth play, or you can buy bonds that pay income. You can buy real estate to flip it and use it as a growth investment by buying it low, selling it higher. You can rent it out for income. So what I recommend at Providence Financial for our clients and for people that are retired is focus on the income component of those investments, not the growth. At least you've got the bird in the hand. If you've got dividend stocks, you can count on the dividends as long as you have a high quality portfolio of dividend paying stock. Same thing with bonds and so on. There's a lot of options that pay dividends: bonds, preferred stocks, REITs, business development companies, dividend paying stock, the whole universe of options that pay dividends. And I think when you're retired, it's the dividend that becomes the focus as opposed to trying to grow your portfolio. And interestingly enough, most of the investments that pay dividends are actually more conservative. So you got to get to kill two birds with one stone, make your portfolio more conservative and get more income at the same time. I think it's a good strategy for people that are retired or close to it.
Anthony Saccaro, President, Providence Financial and Insurance Services. Thank you, Anthony. Good to see you. Thanks.